Welcome to World Revolution Channel. Today we present a summary of the book Think and Trade Like a Champion by Mark Minervini. In Think and Trade Like a Champion, Minervini reveals his battle-tested secrets, rules, and blunt truths to solve the real-life nightmares of emotional trading, massive losses, and missed opportunities that plague most investors. This book arms you with practical tools like the Volatility Contraction Pattern for perfect entry timing, risk-first strategies to protect your capital, and mindset shifts to compound gains instead of mistakes, turning chaotic trading into disciplined, high-performance wins. Whether you're tired of holding losers too long, cutting winners too short, or watching profits evaporate in drawdowns, Minervini's proven SEPA approach provides clear, actionable solutions drawn from over 33 years of real market triumphs. Anyone can achieve super performance in stocks with the right knowledge, plan, and champion mindset. This book is your shortcut to mastering them all and taking full control of your financial destiny. Let's find out more.
That's a fantastic summary, and it really hits the nail on the head. Minervini's whole philosophy, the thing that makes it so powerful, is that he argues trading isn't really a mechanical puzzle, it's a psychological one.
Right.
Before you can even think about executing a perfect entry, you have to become the right kind of person to handle the stress and the emotional chaos of the market. This deep dive is really about that blueprint he lays out.
And let's start with that journey, because his own story is so central to his credibility. This isn't someone who started with a trust fund or an Ivy League education.
Not at all.
He starts poor with very little formal education, just a few $1,000s.
Yeah.
And over 33 years, he turns that into a fortune using his SEPA strategy.
And you have to understand the context of when he started. I mean, the whole system was practically designed to keep the little guy out. We complain about commissions now, but he was paying hundreds of dollars per trade.
Hundreds. That's hard to even imagine.
Right. Yeah, and the spreads, the gap between the bid and ask price could be $2 or $3 wide on a stock. You needed these massive gains just to break even after paying the fees.
So that friction, in a way, was an automatic filter for bad trading. If you were reckless, you were just wiped out instantly.
Exactly. Today, that friction is almost gone, which is great for access, but it means the competition is, 1,000 times faster and more sophisticated. Minervini's point is that the knowledge he provides, that's the real shortcut today. It lets you bypass the decades of mistakes he had to make.
Which brings us to his first big psychological pillar, but one that can be a little tough to swallow at first.
Winning is a choice.
Okay, so that sounds a bit like a motivational poster. What does he actually mean by that?
He means that in every single decision you make, you are consciously or unconsciously choosing to win or lose. And if you argue with that, if you say, oh, it's the market or it's bad luck, you're basically giving up control.
You're saying you're a victim.
You're a victim, exactly. A champion, on the other hand, accepts full responsibility. They go out and find role models, they build a detailed roadmap, and they treat setbacks. Well, they treat them as tuition. They're valuable teachers, not failures.
And he lived this himself, right? He wasn't an overnight success.
No, not even close. He says he dabbled for about 7 years without any real consistent success. The big change came in March 1990. He made a firm, non-negotiable commitment to become the absolute best trader he could be. That was the choice. He stopped dabbling and got serious.
And that decision introduces this internal battle he says we all face. He calls it the tale of two wolves, the builder versus the wrecking ball.
Yeah, and this is happening inside every single trader all the time. The builder is, your ideal self. It's the part of you that's disciplined, that's process-driven.
The part that trusts the system?
It trusts the system. The builder sells at the stop loss because that's the rule, not because it feels good. When the builder makes a mistake, they study it, learn from it, and make sure it doesn't happen again.
And the wrecking ball, that's the self-saboteur.
That's the self-saboteur. It's driven by pure emotion. The thrill of a huge gamble or the ego-driven need to hold a loser just so you don't have to admit you were wrong.
So every day you're choosing which one of those wolves to feed.
Every single trade. Are you feeding the wrecking ball by chasing a hot tip you heard on TV? Or are you feeding the builder by patiently waiting for your setup, defining your risk, and executing your plan? Your actions decide who wins.
This kind of self-sabotage is so common that he actually links it to what he calls the danger of the poverty mentality. And he uses this really intense analogy from a movie.
Right, from Two for the Money. Al Pacino's character has this monologue where he says, some people don't gamble to win. They subconsciously go to lose.
Why?
Because they need the drama. They need that adrenaline rush of the near-death experience to feel alive, or maybe to confirm some deep-seated belief that they just don't deserve to succeed. He calls them leons.
And this poverty mentality isn't just about being poor financially.
No, that's the key. It's an internal belief system. It's a fear of scarcity or a feeling of being undeserving. In trading, it shows up as taking these huge, wild risks or cutting your winners way too short because you're terrified the profit will just vanish.
So the lesson there is, what? Don't be a Leon.
Don't be a Leon. You have to believe that if you put in the work, you do deserve success. But that requires fighting that inner voice that's betting against you.
And to fight that voice, you need internal consistency. He calls this aligning your inner compass.
This is so critical. If your actions are at war with your core beliefs, your beliefs will always win. They'll find a way to sabotage you.
What's an example of that?
Well, think about something simple, like a low-risk trading strategy. If you, deep down, believe that the only way to make big money is to take big risks, no guts, no glory, that whole thing.
Right.
Then trying to follow Minervini's low-risk, high-reward method is going to feel completely wrong. It'll create this inner conflict, and you'll end up breaking the rules without even knowing why.
So if you ever find yourself asking, why did I just do that? I knew better. That's the sign.
That's the signal that your beliefs and your strategy are out of sync. You have to get them aligned first.
And he's very clear that this alignment doesn't come naturally. He argues that the whole idea of a natural-born trader is a total myth.
A complete myth. He says trading is one of the most unnatural things a person can possibly do. It forces you to fight every single human instinct, greed, fear, the desire to be right, the urge to follow the crowd.
He even quotes Peter Lynch, who agreed.
Yeah. And he backs it up with this fascinating study of elite violin students in Berlin. They went looking for the naturally gifted ones.
And they found?
None. Zero. The difference between the elite performers and the merely good ones wasn't talent. It was practice. The top violinists had averaged over 10,000 hours of focused practice. The others, about 4,000.
Wow. So it's just raw effort.
Well, it's not just any effort. It's what's called deep practice. It's constantly getting feedback, making tiny adjustments, and always pushing yourself just a little bit outside your comfort zone.
You can't just jump from being a beginner to being a master.
No, you build it one step at a time. The goal is to drill your process so deeply that when the market is going crazy and the pressure is on, you just execute. You don't think, you don't feel, you just follow the plan automatically.
And Minervini's own story is proof of that. He took 6 years to get consistently profitable.
6 long years sticking to one strategy, refining it over and over. That persistence, he says, is way more important than just having a bunch of market knowledge.
Okay, so that powerful psychological foundation is step one, but it's all in preparation for the practical side, which brings us to part 2. Always go in with a plan.
Exactly. If you fed the builder wolf, the builder's going to demand a blueprint.
And he's pretty blunt about this. He says it's insane that people will risk, $100,000 on a stock with less research than they do buying an $800 TV.
It's pure recklessness, driven by greed. Think about it. A surgeon has a plan. A pilot has a checklist. A builder has a blueprint. Why would you risk your life savings with less preparation?
And he says so many investors start with a broken plan anyway. Like just buying big-name stocks that are beaten down, thinking they're safe.
Which is a huge mistake. His point is that a plan, a process, gives you a baseline for what to expect. This is why he says hope is not a plan.
Because hope is what leads to rationalization.
It's the absolute enemy. Your plan tells you, objectively, if a trade is working or not. Hope just tells you to be patient and wait for it to come back while your account is bleeding out. It's emotional paralysis.
So to kill that hope, You need contingency planning. You have to prepare for everything in advance.
Everything. Professionals work out their responses to almost any situation before it happens. When things get chaotic, they don't have to think. They just execute the pre-planned response.
So let's walk through those must-have contingencies. What's number one?
Number one, the absolute foundation. Where you will exit if the position goes against you. That's your stop loss. It has to be defined, down to the penny, before you click the buy button.
Okay, that's the plan for failure. What if you get stopped out?
That's contingency number two, your criteria for re-entry. An amateur gets stopped out, feels burned, and never wants to look at that stock again.
Right.
A professional looks at it objectively. Was it just some volatility that shook me out? If the stock recovers and sets up again according to my rules, I'll go back in. It's a new trade, a new opportunity.
And then you have to plan for success, too.
You do. Contingency 3 is your criteria for selling into strength to lock in a profit. Maybe that's when you're up 2 or 3 times your initial risk. And number 4 is when to sell into weakness to protect that profit you've already made.
And the final one is the real worst-case scenario.
The disaster plan. What if your internet goes down during a market crash? What if your broker's whole system fails? A pro might have a funded account at a second brokerage, just in case, so they can get out if they have to. It's about preparedness.
This all fits into what he calls the hierarchy of protection, the ABC priorities.
Yeah, think of it like climbing a mountain. Point A is base camp 1. That's setting your initial stop loss. You limit your maximum loss from the very beginning.
Okay.
Then the stock moves in your favor. Now you move to point B, protect your line. You raise your stop loss up to your break-even price. Now you literally cannot lose money on the trade. You're playing with the house's money.
And point C.
Point C is protecting your profit. The stock keeps running. Now you set a trailing stop or a backstop. You've locked in a substantial gain and ensured that a great winning trade can never, ever turn into a loser. It's an active process.
So once a stock breaks out, you need to see confirmation that the big money is behind it. This is where he uses that great analogy. Tennis balls versus eggs.
I love this one. It's so visual. So a stock breaks out of its base. What you're looking for is follow-through buying from institutions. Then you'll get a pullback. It's inevitable.
And a healthy stock acts like a tennis ball.
Right. You drop a tennis ball, it bounces back hard and fast. A healthy pullback is short, it's shallow, and buyers step in immediately to support the price. The stock snaps right back to new highs.
But if it's a weak move, you get egg action.
Egg action. Splat. The stock pulls back and just sits there. It can't recover. It's heavy. That's a sign that there's no real institutional demand.
And sometimes the market gives you even clearer signals that something is wrong, even before your stop is hit. These are the warning signs or violations.
A good plan has to account for these. These are technical red flags that tell you the odds have shifted against you and you should probably get out early.
What's the biggest one after a breakout?
A close below the 20-day moving average shortly after a VCP breakout. His research shows this cuts the probability of the trade succeeding in half. Right there. It's a huge warning.
What else?
You look for 3 consecutive lower closes on increasing volume. That's a sign of heavy distribution institutions are dumping shares. And another one is a low volume breakout, followed by high volume selling back into the base. The famous trader Dan Zanger said, winning horses don't back up into the gate.
Right. If it can't hold the breakout, it's a failed move.
It's a failed move, and you have to respect that.
But you said we shouldn't panic at the first sign of a stall, the squat. How do you know the difference?
A squat is just a momentary pause, often on the breakout day itself. It's normal. As long as your stop isn't hit and you don't see one of those major violations, you give it a little time and space to work. You wait for the reversal recovery, where it overcomes that stall, instead of letting your fear push you out too early.
If you don't have this plan, with all these contingencies and rules, you get stuck in what he calls the paralysis regret cycle.
Oh, it's the worst place to be. You're constantly frozen. Should I buy? Should I sell? And then after the fact, you're crushed by regret. I should have sold. I should have held. A plan gives you an objective framework, so you're not making decisions based on fear and greed. It kills the paralysis.
And that framework has to start with risk. This moves us right into part 3. Approach every trade risk first.
This is the core of the whole system. Amateurs think about how much they can make. Professionals think, first and always, about how much they can lose.
Because if you lose your capital, the game's over.
The game is over, period. Which is why the stop loss has to be determined before you enter. He says trading without a stop is like driving a Ferrari without brakes. You might get away with it for a while, but eventually, a catastrophic crash is guaranteed.
And he makes a key distinction between a mathematical stop and an emotional stop loss.
Everyone has an emotional stop loss. It's that point where the pain just becomes unbearable and you finally sell. For most amateurs, that point is, 30, 40, maybe 50% down.
A financially and psychologically devastating loss.
Totally. And it's what creates what Jesse Livermore called the involuntary investor.
I love that term.
It's perfect, isn't it? You're a trader when you're right and taking quick profits, but as soon as a trade goes against you, you suddenly become a long-term investor, telling yourself you'll just hold it until it comes back. It's pure rationalization to avoid taking a small loss.
And part of avoiding those big losses is choosing the right stocks to begin with, which he explains with his Black Orchid lesson.
Yeah, this is a great story from his childhood. He was on a horse farm and got put on this really wild, volatile horse named Black Orchid. It was fast, but it bucked him off and ran right over him.
Ouch.
The lesson was clear. Avoid the bucking bronco stocks. They might be fast, but they're so volatile they'll just shake you out of the trade constantly. You want the obedient horse, the alpha, that can go the distance smoothly. You trade a little bit of volatility for a lot more stability.
It all comes back to ego, doesn't it? Knowing what you can and can't control.
100%. You can only control 4 things. What you buy, how much you buy, when you buy, and when you sell. That's it. You cannot control the price. The market is never wrong. Only you can be wrong.
And the ego is what makes people say, I'll just sell when I get back to even.
It's a classic. You're prioritizing being right over being profitable. And that's where the math becomes so important. The reward-risk ratio is everything.
This part is so powerful. Explain why a trader with a simple 2-to-1 reward-to-risk ratio can make 10 times more money than someone chasing huge gains but taking huge losses.
It's because losses work against you geometrically. A 10% loss requires an 11% gain to get back to even. A 50% loss requires a 100% gain just to get back to zero. The hole gets exponentially deeper.
That's brutal.
It's brutal. So if your average loss is huge, say 21%, you'll have a few big winners, but the losers will wipe you out over time because the math is just insurmountable. Keeping losses small is the single most important thing.
And this leads to a strategy that is completely backward from what most people would do, the inverted strategy.
Right. When most people start losing, their instinct is to loosen their stops. They think, oh, I'm getting stopped out too early.
But the pro does the opposite.
The exact opposite. When your performance slips, you tighten your stop losses and you take smaller profits. You reduce your risk until you get back in sync with the market. You only get aggressive and let your winners run when you're already trading well.
And your risk has to be based on reality, not hope. What he calls result-based assumption.
This just means you have to use your own data. If your actual documented average winning trade is 10%, it's useless to set a stop loss assuming you're going to make a 40% gain. Your risk has to be proportional to your proven reward.
Okay, before we get to accountability, how do you increase your position size without blowing up this risk model?
Through the add and reduce technique. It's a smart way to pyramid. You start with a pilot buy. Once the stock moves in your favor and hits a second buy point, you add more shares.
But the key is what you do with the stop loss.
The key is you immediately move the stop up on the entire position. So you're increasing your exposure to the upside, but you're simultaneously reducing your overall capital at risk. You're using the market's money to finance the bigger position.
It's brilliant. This all leads to part 4. Know the truth about your trading. Brutal honesty.
He says you can make money or you can make excuses, but you can't make both. Winners study every single trade like it's a gold nugget. They eliminate the excuse factor entirely.
And the way you do that is by tracking the three legs of the trading triangle.
Your average win, your average loss, and your batting average, the percentage of winning trades. If you don't know those three numbers, you don't actually have an edge. You're just gambling.
And he has these specific stubborn trader indicators to look for.
Yeah, these are designed to expose your bad habits. Is your biggest loss each month bigger than your biggest gain? Are you holding your losers for more days than you hold your winners? The data doesn't lie.
The goal is for your results to be skewed to the right.
Exactly. Imagine a bell curve. You want all your losses to be bunched up in a tight little group on the far left, small and contained, and you want the tail of your winners to stretch way out to the right with a few really big outlier gains. That's the visual proof of a winning system.
And part of that system is understanding the power of turnover and compounding.
People totally underestimate this. His example is eye-opening. 6 separate 10% gains, when compounded, give you almost double the return of one single 40% winner.
So it's better to hit a lot of singles and doubles than to wait for one home run.
For most people, yes. Higher turnover, moving capital efficiently from one good opportunity to the next can be much more profitable. Holding on to dead money is a massive opportunity cost.
And to deal with the anxiety of holding a winning stock, he gives us a really practical tool. The sell half rule.
This is a psychological masterstroke. The rule is, once a stock is up a nice amount, say 2 or 3 times what you risked, you sell half the position.
And the beauty is in how it makes you feel, no matter what happens next.
Perfect. If the stock keeps going up, you say, thank goodness I kept half. If it reverses and goes down, you say, thank goodness I sold half. It completely neutralizes regret and lets you manage the rest of the position with a clear head.
But he's very clear. This is only for taking profits.
Only for profits. Never, ever sell half on the downside. When your stop is hit, you sell the entire position. No hesitation.
Which brings us to the deadliest mistake of all. Averaging down.
Throwing good money after bad. He says it's the fastest way to blow up an account. It's a decision driven 100% by ego, the desire to be proven right, and it's a total delusion.
He keeps a quote from Paul Tudor Jones on his desk about this.
Losers, average losers. That says it all. You are increasing your risk in a position that the market is actively telling you is wrong. The worst thing that can happen is that it works once because that reinforces a catastrophic habit.
This danger is especially true for former market leaders, which is where his 50-80 rule comes in.
This is a sobering one. Once a major market-leading stock finally tops out, there's a 50% chance it will fall 80%, and an 80% chance it will fall 50%. These things don't just pull back politely, they crash.
And this often happens while the news still sounds great, which he explains with differential disclosure.
Right. It means the big institutional players know things, or at least interpret the price action before the public does. While retail is buying on good earnings news, the institutions are often using that liquidity to sell huge positions.
So the price action is the only truth.
The price is the only truth. Never buy a story if the price doesn't confirm it. You always want to be buying on the way up, not trying to catch a falling knife.
Okay, so to wrap this up, the goal is to compound money, not mistakes, by scaling up on winners and scaling down on losers.
This is the key to longevity. You want to be trading your smallest size when you're trading your worst and your largest size when you're trading your best.
How do you do that?
You start with a small pilot position. You only increase your size, maybe double it after a winning trade. So if you have a string of wins, your size grows. The profits are financing the increased risk. But the second you have a loss, you cut your size back down immediately.
And the final piece of the mathematical puzzle is to never lay odds.
You have to have an edge. If a trade is just a 50-50 coin flip and you're risking $1 to make $1, you will go broke over time just from commissions and slippage. You have to be trader B, risking $1 to make 3 or 4. That's your mathematical advantage.
This all brings us to the final thought, really, that trading isn't just about money. It's a path to self-mastery.
It really is. Longevity in this game means protecting your capital and your profits like a hawk. He says yesterday's profit is today's principal. You can't ever let a good gain turn back into a loss.
It seems like the big takeaway is that, yes, big rewards with low risk are possible, But it's only possible if you master your own mind, your own ego, your own fear.
The key to all of it, the consistency, comes from relentless self-discipline. He says you have to be like a drill sergeant following standard operating procedure. So the real question for anyone listening is, a tough one. Are you willing to become your own drill sergeant? Because that discipline is the only thing that separates the great performers from everyone else.
Thank you for watching, Hope. Please like up, share, subscribe, follow up in the next topic. Come back to continue think and trade like a champion. Welcome back, everyone, to the Deep Dive. Today, we are taking the blueprint for success. And I mean really taking it apart piece by piece. We're looking at super performance in the incredibly competitive world of the stock market. And we're going to meticulously break down not just the advanced tactics, but maybe even more importantly, the powerful mindset you need to actually execute them. Our deep dive today is really custom tailored for you. It's drawn directly from the playbook of a U.S. investing champion. So we are moving way beyond, the basic investing philosophy. Our sources are focusing entirely on the tactical core. We're talking about the exact mechanics of execution, precision risk management, and this is the big one. The ironclad mental toughness you need to handle what the market throws at you. And of course, how to avoid those psychological traps that, they lead to self-sabotage.
That's absolutely right. The mission here really is to shift the focus. We're moving from just what to buy, which is where everyone starts.
Right, to stock tip.
The stock tip, exactly. And we're moving to how to manage the entire cycle, the buying, the sizing, and the selling, with the precision of a master craftsman. We're focusing on avoiding those catastrophic, those big drawdowns that just crush your capital and your confidence. Mm-hmm. And at the same time, positioning for the outsized gains that define what super performance actually is. So this isn't just a guide to picking a stock. Think of it more like a complete operational manual, and it's designed for repeatable success.
Okay, an operational manual. I like that. Let's unpack this playbook then, starting with what you call the very first non-negotiable principle of buying, making sure you have the market's momentum on your side.
Yeah, the foundational rule it's remarkably straightforward, but it's amazing how consistently it's ignored by, I'd say, the vast majority of retail traders. You absolutely must trade with the trend.
It sounds so.
It is. But it's not just common sense. It's really a mandate for leveraging institutional flow. You want the big money on your side. The analogy that really stands out from the sources is that you have to always have the wind at your back. Think of it like a surfer catching a huge wave.
You're not paddling against it.
Never. If you try to buy stocks that have been just hammered down, 50, 60%, what we call bottom fishing, you're fighting the tide. You're just expending unnecessary capital and energy against this overwhelmingly powerful force.
And fighting the tide isn't just expensive. It's often a sign that you're ignoring a much deeper problem with the company or the stock. So the goal is to find stocks that are already showing health, that are showing that institutional accumulation you mentioned, the kind you need for a major advance, which brings us directly to understanding the stock's natural progression, what's called the 4 stages of a stock's life cycle.
Exactly. This framework, it's like a stock's technical EKG. It gives you immediate context on where that stock is in its maturity curve. So first you have stage 1, that's neglect or consolidation. The stock is just moving sideways, volume is usually pretty low, and institutions, they haven't committed yet. It's building a base.
Okay, just quiet.
Very quiet. Then comes stage 2, advancing or accumulation. Now, this is the sweet spot.
This is where we want to be.
This is it. Institutions are buying aggressively, demand is overwhelming supply, and the stock is moving strongly upward. After that, you get stage 3, which is topping or distribution. Now the institutions are selling into all that retail enthusiasm. The stock gets volatile. It forms these wide, loose patterns.
The party's getting a little wild.
A little too wild. And finally, stage 4, declining or capitulation. The stock is in a confirmed downtrend, and it's often falling dramatically on really high volume. The champion's rule here is absolute. You should only be buying stocks in a confirmed stage 2 uptrend. Or, maybe just occasionally, right at that transition from stage 1 into stage 2. But Buying in a downtrend in stage 4 is just structurally unsound. It's like a doctor ignoring a life-threatening illness because they found one minor positive metric.
Ah, right.
You're ignoring the stock's biggest health concern, which is the trend itself.
So if stage 2 is the required hunting ground, how do we confirm a stock is truly healthy and not just, having a good week?
Yeah.
That's where this meticulous trend template comes in, an 8-point non-negotiable checklist.
This template is your entry filter. It's your military-grade weather report. If a stock fails even one of these criteria, it's out immediately.
No second chances.
None. We are looking for confirmation that the big money is already involved and that the trajectory is already established. So the first 4 criteria are all about the structure of the stock's moving averages, or MAs. First, the price has to be above the 200-day moving average. That confirms long-term health.
The baseline.
The baseline. Second, that 200-day MA has to be trending up. It's got to be moving higher for at least a month, which shows sustainable strength, not just a momentary spike. Third, the 50-day MA must be above the 150-day MA. And fourth, both the 50-day and the 150-day MAs must be above that 200-day MA.
Okay, let's pause on that for a second for the learner. That nested structure of the moving averages. The 50 over the 150 over the 200. Why is that specific stacking so critical? Why not just look at the 200-day?
That's a great question. It's because it confirms that the intermediate term strength is dominating the medium term, which is then backed up by the long-term trend. See, the 50-day tracks the short-term trend, the 150 is the medium, and the 200 is the long-term. When all 3 are stacked and pointing upward, it means the stock's health is improving across all time frames at the same time. That's synchronization. That's a crystal clear indicator of institutional accumulation. They're not just day trading, they're building significant long-term positions.
Got it. So beyond the averages, the checklist moves into price location. And this is where it really starts to challenge that conventional wisdom about finding bargains.
Absolutely. Criteria 5 and 6 deal with price proximity to highs and lows. Number 5, the price must be within 25% of its 52-week high. And really, the closer, the better.
Why?
Because the greatest winners must make new highs. Being near the high shows leadership. It's that simple. And number 6, the price must be at least 25% above its 52-week low. Many super performers are already up 100%, 300% off their lows before that final explosive run even begins.
So you want stocks that have already proven they're being bought up like crazy.
That is the key distinction. The average amateur, they're looking for a stock that's down 80%, and they're just hoping it gets back to its former glory.
The hope trade.
It's all hope. The champion is looking for a stock that's already up 80% and is showing absolutely no signs of slowing down.
It's the difference between hope and evidence.
That's it, exactly. And the final crucial factors relate to relative strength, or RS. The IBD ranking should be no less than 70, but ideally you want it in the 90s.
And that just compares it to all the other stocks out there.
Yep, it compares the stock's price performance over the last 12 months to every other stock in the database. A 90s ranking means it's outperforming 90% of the entire market. But the IBD number alone isn't enough. We need the RS line, the actual line you see on a chart, to be in a persistent uptrend for at least 6 weeks, preferably 13 weeks or more. This proves the stock is consistently leading, not just having a temporary pop.
Okay, so we've used the template. We found our confirmed stage 2 stock. The momentum is there. The big money is clearly accumulating. The next challenge is pinpointing that optimal entry and avoiding the common mistake of buying right into a wall of sellers. This brings us to the concept of overhead supply.
Overhead supply. It's this invisible ceiling, and it's created by track buyers.
Track buyers.
Yeah, these are investors who bought the stock at higher prices, maybe during a previous downturn or consolidation. Now, as the stock rallies back up toward what they paid for it, they are just psychologically primed to sell just to break even.
Oh, that thank goodness I got my money back feeling.
That's the exact feeling.
Yeah.
And that massive collective desire to get out at break even creates this dense area of supply resistance that the stock has to chew through before it can advance freely.
And the mechanism the best stocks use to clear out all that psychological and actual supply is the Volatility Contraction Pattern, or VCP.
The VCP is really the heartbeat of a proper consolidation. It's what's called a continuation pattern, so it has to happen inside that healthy stage 2 uptrend. It's where the price pullbacks get successively tighter.
So it's shaking people out.
It's shaking out all the weak hands. A stock might pull back, say, 16%. Then the next pullback is only 8%, then 6%. And finally, you get this tiny 3% wiggle right before the breakout. This tightening volatility shows that the selling pressure, the supply, is just diminishing rapidly. The trapped buyers are finally exhausted.
The moment of truth, then, is what's called the pivot point.
The pivot point is the specific call to action price. It's the level that marks the successful completion of that whole consolidation process. It's the price that, once it's crossed, means the stock is now above the last resistance point and it's entering what's called the line of least resistance.
So that's the buy signal.
That's the buy signal. You buy as close to that price as you possibly can, ideally right at the pivot, and certainly no more than a few percentage points above it, otherwise you're just chasing the move.
If we trust that this pivot point isn't just a fake out, the sources really emphasize that the secret is in what the volume is doing during that consolidation.
This is the critical technical tell, and it's so often missed by less experienced traders. A correct VCP requires significant volume contraction. Volume often has to fall way, way below its 50-day average. During that tightest phase of the VCP, volume should just dry up to a trickle. This signifies a selling vacuum.
A selling vacuum.
Yes.
Yeah.
Because if there's almost no supply available, even a tiny increase in demand, the institutional money coming back in, can move the price up really, really rapidly, and that ensures the breakout is sustained.
There's a perfect illustration of this in the sources with Mercadolibra, MELI.
Yeah.
Walk us through that chart, because that ascent after the pivot was just incredible.
Oh, the MELI chart was a classic. It formed this 6-week base where the price corrections tightened dramatically. Textbook VCP action. After it successfully absorbed all that supply, the stock crossed its pivot point. And what happened next is what defines superperformance. The stock immediately shot up an astonishing 75% in only 13 days.
13 days.
13 days. A massive move in a really compressed time frame, and that kind of rapid price jump. It only happens when that overhead supply is completely gone, creating that vacuum, and the stock is trading in that line of least resistance.
That momentum, it makes sure you don't waste time. Remember David Ryan noted, winning horses don't back up into the gate. So if a stock breaks out on low volume but then immediately pulls back into the base on high volume a few days later, that's a bad sign.
That's a huge red flag. It tells you the supply wasn't truly cleared out, and the breakout is very likely to fail. The whole goal here is efficiency. You want your capital working for you immediately, not just sitting in a trade that grinds sideways for 6 months while it works through old supply issues.
Okay, so we've built a foundation. A healthy stage 2 stock, a proper VCP entry. Now let's get a little more advanced and refine that buying filter. The sources warn that not all consolidations are created equal, especially when it comes to how deep they are.
All right, we need to focus on the correction depth. We're looking for a base, but we want to avoid a total collapse. Most constructive, healthy setups correct somewhere between a shallow 10% and, a deep but still manageable 35%. When a stock declines 50 or 60% off its high, that is often a failure-prone setup.
Why is that?
Well, it either signals a serious underlying fundamental problem with the company, or, more commonly, it just creates such overwhelming overhead supply that the stock is going to struggle for months, if not years, to rally back.
This brings us right back to that pervasive and, frankly, misleading piece of investing wisdom. Buy low, sell high. The Champion's playbook argues pretty forcefully that you have to buy high.
The phrase buy low, sell high sounds great in theory, but in practice it usually just means you're buying distressed assets that may never recover. The truth is, big winners must make new highs. It's a requirement. A stock that's trading near its 52-week low has zero upward momentum, zero institutional support, and it's facing this massive wall of overhead supply.
All those trapped buyers.
Every single time it rallies a little bit, a new group of those trapped buyers sells out at break even. It's just a slog. By contrast, a stock hitting a new high, as long as it follows all our VCP and trend template rules, has zero overhead supply above it.
Blue sky.
Blue sky. It's demonstrating that the market judges its prospects to be better than ever before. And the sources are really clear on this. True leaders always appear too expensive to amateurs. The major moves, the super performance, that often only truly begins after a stock has cleared its all-time high. You're paying a premium for clarity and confirmed strength.
So relative strength, which we talked about with the template, is not just a static number, it's more of a dynamic signal. How does the champion look at that RS ranking versus the actual technical action on the chart?
It's the synthesis of the two. You have to combine them. The IBD ranking is a great quantitative filter. It gets you in the right ballpark. But you have to pair it with the technical action. You want a stock with a high ranking that is emerging from a sound, tight VCP consolidation.
Not one that's already at 50% from the breakout.
Exactly. If you only focus on the ranking, you can end up chasing stocks that have already moved too far and are extended, which makes them ripe for a 30% correction. The champion uses the RS ranking to identify the neighborhood where the leaders live, but they use the VCP and the pivot point to find the exact address and the precise time to knock on the door.
What's really fascinating to me is the timing edge that true leaders display, particularly around major market bottoms. This seems like a critical divergence sign.
No, it's a huge early warning system for the overall health of the market. Market leaders do not wait for the general market to give the all clear. They often emerge from their consolidations before or right at the moment the major indexes finally bottom out.
So while the S&P 500 is still going down.
Right, you might see the S&P or the NASDAQ during a major correction, and they're still grinding lower, making lower lows. But if you see a confirmed leader start to build a tight, shallow base, and it's making higher lows, that divergence is just screaming at you that the smart money is re-entering this specific stock, regardless of what the index is doing.
The case study of Amazon, AMZN, during the 2002 bear market comes to mind.
That example is textbook. The overall market was just collapsing through 2001 and 2002. It was a 31-month bear market. AMZN formed a 22-week base showing clear accumulation. It finally moved above its pivot point on October 10th, 2002.
Which was?
The exact day the S&P 500 finally hit its low and reversed. The strength was already building under the surface while the indexes were making their final capitulation.
Wow.
And another classic example is Netflix, NFLX. It bottomed in October 2008. That was a full 5 months before the S&P 500 finally capitulated and bottomed in March of 2009. So while the index was still suffering, NFLX shot up 125%. Leaders bottom first, and they tell you when the recovery is coming.
The ultimate lesson here seems to be letting the market, not your personal preference, dictate where your capital goes. You can't play favorites just because you like a product or a company name.
The market's wisdom is absolute. It far exceeds any individual bias you or I might have. You have to buy in order of strength. The stocks that break out first show the strongest relative strength and exhibit the most confirmed technical action. Those are your best candidates, period. You have to eliminate that emotional preference for a stock name and acquire the first mover advantage that comes from tracking these proven leaders.
Okay, now let's discuss an even earlier entry point. This is for the disciplined trader who's looking to maximize their gain, the 3C pattern, or the cup completion sheet. This sounds like it allows you to get in before that classic pivot.
The 3C pattern is the earliest possible low-risk entry. It gives you a cheat to lower your average cost basis. It's an aggressive move for sure, but it can be highly effective when you use it correctly. But, and this is important, it has to meet the core qualifications. The stock must be in a stage 2 uptrend, and it typically needs to have already advanced, say, 25 to 100% in the period before.
And the pattern itself.
Usually pretty contained, maybe 7 to 25 weeks. And crucially, we avoid patterns with corrections greater than 60%. Those are just too failure prone.
So walk us through the 4 psychological and technical steps of this pattern.
Okay, so step 1 is the intermediate downtrend. We can call that A. The stock has run up, but then it corrects within that larger stage 2 uptrend. Step 2 is the uptrend recovery, B. The price starts to rally back, typically recovering about a third to a half of that prior decline. But this recovery usually stalls out as it hits the overhead supply from that initial downtrend.
The trapped buyers again.
Always. Then comes step 3, the pause or the cheat, C. And this is where the magic happens. The stock pauses. It forms this very tight little plateau over several days or weeks, and it's contained within a really tight range, maybe 5 to 10% from high to low. That tightness is the signal that the supply is being completely absorbed, but at a lower level than the final pivot point would be.
And what has to be happening with volume during that tight pause for it to trust this cheat entry?
Volume has to contract dramatically. It must dry up to a selling vacuum. This extreme tightness in price, combined with that super low volume, tells us the stock is ready to turn up decisively. So you buy at the high of that tight plateau area.
And step 4 is the breakout.
Step 4 is the breakout, D. As the stock rallies above that specific cheap buy point, it confirms its intermediate-term trend is up again.
The examples of Cirrus Logic, CRUS, and Google, GOGA, back in 2004, really show how powerful this can be. It's a highly accurate, low-risk entry. But just as importantly, it gives you a crystal clear exit point.
Absolutely. The beauty of the cheat is the defined risk. If the price fails to hold the low point of that tight plateau, the low of the cheat you sell, immediately something is wrong, the pattern isn't working, it just removes all the indecision because your stop is so tightly contained. It ensures a small, manageable loss if you're wrong, but it gives you maximum leverage if you're right.
Okay, let's shift gears now. We've gone deep on the technical entry criteria. Now let's talk about the capital management mechanics, because this is really where the champion separates themselves from the amateur. The philosophy is fundamentally risk first.
Risk first is paramount. It has to be. Position sizing is the ultimate control mechanism for your portfolio's risk. It's not just a way to allocate money. Before you even think about entering a trade, you must know your maximum loss exposure. This is the concept of backing into risk.
Backing into risk.
So if you decide your maximum acceptable risk per trade is, say, 2.50% of your total trading equity, you use that number to calculate your position size. For example, if you place a 7% stop loss on a stock, you calculate the position size that ensures that if the stock hits that 7% stop, your overall portfolio only loses 2.50%.
And if you need a wider stop,
then you must decrease your position size accordingly. If you need a 10% stop, your position size gets smaller to keep that total portfolio loss at 2.50%.
and this creates a necessary balancing act, right? Tighter stops mean less capital risk, but you're more likely to get stopped out by just normal market noise. Whereas wider stops protect you from the noise, but lead to much larger losses if the trade is just plain wrong.
It's a constant calibration. The amateur is focused on the return. The champion is focused on the risk and the volatility. By defining the loss first, you ensure that even a string of losers doesn't critically damage your capital or your confidence.
This disciplined, risk-first approach, it directly supports the philosophy of the power of concentration. And this runs completely counter to conventional financial advice, which just screams, diversify, diversify, diversify. Champions concentrate their capital into the very best 4 to 6 stocks. Why take on that massive concentration risk?
It's a strategic choice, and it's based on 2 key factors: monitoring capability and mathematical efficiency. First, if you're holding 15 or 20 positions, it is virtually impossible to monitor all of them effectively.
I just can't keep up.
You can't. When the market turns on a dime or one of your stocks flashes a climax sell signal, you can't react quickly enough across that many names. By concentrating in just 4 to 6 names, you become an expert in those specific stocks, and that allows for rapid and precise tactical action. Second, the math suggests that if you're aiming for a sustainable 2-to-1 reward-to-risk ratio—
Oh, for every dollar you risk, you expect to make 2.
Correct. The mathematically optimal position sizing is roughly 25% of your portfolio in 4 equally weighted concentrated stocks. Dispersion or diversification actually diminishes your ability to generate those truly outsized returns because your big winners are just offset by the mediocrity of all your other positions.
But the learner has to be asking, Isn't that incredibly risky? I mean, if one of those 4 to 6 stocks has a major unexpected failure, like an accounting scandal, you've just wiped out a massive chunk of your account instantly. How do champions mitigate that risk of concentrated failure?
They mitigate it through constant, ruthless portfolio hygiene. And that's enforced by that risk-first methodology we just talked about. If a stock starts to act poorly, it is cut quickly, especially because it's a concentrated position. This is where the concept of the garden analogy becomes absolutely vital.
The garden analogy.
You have to view your portfolio like a gardener views their plot. You have to actively pull the weeds, the mediocre, the average performers, and you have to water the flowers, the stellar performers. A stock that isn't hitting its stop but is just sitting there grinding sideways, that is dead money.
It's an opportunity cost.
It's a massive opportunity cost. It's consuming your capital and, more importantly, your opportunity time. That capital could be deployed into a new leader that's generating rapid, compounded returns.
So the biggest cost of a mediocre stock isn't the small loss. It's the cost of that capital just sitting dormant. And the solution to this portfolio hygiene problem is the tactical 2-for-1 rule for capital reallocation.
The 2-for-1 rule is a practical, immediate reallocation strategy that keeps your capital cycling into your best ideas. Here's how it works. Let's say you have 2 mediocre or underperforming stocks, and they're both sitting at a 20% position size.
Okay.
They're not going up much, but they haven't hit their stop either. You sell half of each of those 2 positions. That immediately raises 20% of your total portfolio capital. You then take that 20% and you invest it into one new, highly promising candidate that meets every single one of your trend template and VCP criteria. You're continuously funding your most promising new ideas by trimming your weakest existing ones. This is active portfolio management, not passive holding.
This continuous trimming and reinvesting, it feeds directly into the overarching concept of scaling and compounding success.
Yes, the core philosophy here is really simple. You must ensure that when you're trading your worst, you're trading your smallest. And conversely, when your analysis and your timing are proven correct, you are trading your largest.
How do you do that in practice?
You start with a small position, often called a pilot buy, maybe a quarter of your intended size. If that trade works, if it generates an immediate cushion of profit, you immediately double the size on the heels of that win. If losses start to mount, you progressively scale back your exposure.
And what's the profound psychological benefit of this reverse scaling, where you trade small when you're losing?
It protects your confidence. Losses are critical information. They're telling you either your timing is off or the general market is deteriorating. If you increase your exposure when you're losing, you're engaging in destructive revenge trading, trying to win back losses by betting bigger.
Which never works.
Never works. By scaling down when things go wrong, you are following the market's guidance. You're preserving your capital and your mental state, and you're allowing yourself to be ready to step up again when your analysis is confirmed by profitable action. It completely flips the dangerous tendency of amateurs to average down on losers, which, champion traders know as simply averaging losers. You have to compound money, not mistakes.
We've established the buying and the sizing rules. Now for the hardest part, the part where most profits are really squandered, selling. Most traders spend, 90% of their energy on buying and 10% on selling, but the reverse is where the profit is actually secured. We start by gaining context, using something called the base count.
Selling absolutely requires context. You need to assess where the stock is in its technical life cycle using this base count. Stocks advance, then they consolidate, form a base, and then they advance again. That's the cycle. So bases 1 or 2, especially if they're coming after a major market correction, those are early stage. These are the stocks you must give time to run because they have the highest probability of becoming massive winners.
You have to be patient with those.
Very patient. But bases 5 or 6, those are late stage, and they are extremely failure prone. By this point, the stock has often made several large runs, and the big money has started thinking about distribution. You have to treat these late-stage bases as short-term trading opportunities, not long-term holdings.
And there's a powerful fundamental red flag that often confirms this late-stage risk: PE expansion.
This is a critical warning sign for any extended stock. If the price-to-earnings ratio has doubled or more, for example, if it was trading at 20 times earnings at base 1, but by base 4 or 5 it's at 40 or 50 times, you must exercise extreme caution.
Why is that so dangerous?
It indicates that the stock's price appreciation has run dramatically ahead of its actual earnings growth. The market is pricing in absolute perfection.
No room for error.
Zero room for error. And that signals a high risk of collapse if the company even slightly disappoints. The charts of Decker's and Chipotle Mexican Grill show this perfectly massive PE expansion right before the final peak and a major decline.
So once a stock is identified as late stage and extended, we shift to looking for signals to sell into strength, specifically by identifying the climax top. Why is it mandatory to sell on the way up rather than trying to wait for the absolute peak?
Because institutions who need to liquidate these massive blocks of shares, they can't just sell into a quiet market. They need eager, emotionally driven retail demand to absorb their supply.
Any buyers.
Lots of buyers. And that occurs precisely during that accelerated advance phase, the blow-off top. If you wait for the peak and the subsequent crash, you are guaranteed to give back a substantial, often crippling portion of your profits.
So what defines that climax top moment? What does it look like?
It's defined by an accelerated rate of advance. The price runs up 25 to 50% or more over a very compressed period, usually 1 to 3 weeks. The sources highlight the dramatic example of Qualcomm, QCOM, back in 1999.
Oh, yeah.
The stock advanced a staggering 260% in just 2 months. But the final blow-off was a 73% vertical spike in 6 days. Now, the trader who held through that incredible move but failed to sell into that climax, they watched QCOM subsequently fall 88%.
Ouch.
It just showcases the destructive speed of institutional distribution.
And there are highly specific technical warnings that the champion trader needs to be counting during this accelerated phase. What are those granular tracking points?
You're looking for a few key things on an extended stock. First, a high concentration of up days. Look for a pattern where 70% or more of the days are up days versus down days over a 7 to 15-day period. This signals aggressive, indiscriminate buying.
Okay.
Second, look for the widest spread. The largest up day and/or the widest daily spread, the difference between the high and the low for the day since the entire move began. This is a classic sign of extreme euphoria, the final push. Third, exhaustion gaps. Spot recent gaps to the upside that show irrational enthusiasm but fail to follow through. And fourth, and most critically, watch for high-volume reversal days, where the stock closes near the low of the day after hitting a new high. This strongly suggests institutional selling is overwhelming all that retail demand.
The big money is getting out.
Liquidation occurs when everything looks best because strong professional hands are dumping shares onto weak retail hands.
Okay. Shifting from selling into strength to protecting against a catastrophe. What if a late-stage stock just suddenly breaks hard?
You don't fight the tsunami. If a late-stage stock experiences a major break, the largest daily or weekly price decline on overwhelming volume since its stage 2 advance began, you sell immediately.
No questions asked.
No time for rationalization. Do not listen to news anchors or positive company press releases. The price action itself is a red flag, signaling what's called differential disclosure. It means the institutional players have information or a negative insight that the public doesn't have yet. You have to listen to the stock, not the story.
To protect the integrity of your capital and your longevity, we have 2 excellent rules for locking in gains. First is the break-even or better rule.
This rule just ensures you never allow a good gain to devolve into a loss. Once a stock is profitable, you have to move your stop to protect that gain. The 50-day moving average is a highly effective, non-negotiable trailing stop for market leaders.
Why the 50 days specifically?
Because leaders often run for an amazing distance without ever closing below that 50-day line. But once they do, it signals a fundamental change in institutional support. It is a non-negotiable sell to protect your principal and your profits. The worst thing a champion can do is give back profits on a winner.
And the second rule is a psychological masterstroke. It's designed to neutralize regret and indecision. It's called the free roll.
The free roll is essential for removing the emotional component from holding a big winner. Once the stock is up 2 or 3 times your initial risk. So, for example, if you had a 7% stop and the stock is now up 14% to 21%, you sell half the position.
Bank half.
Bank half. And you immediately move the stop on the remaining half to your break-even point or the original stop. Now, psychologically, you are entirely protected. You've banked a guaranteed profit on half the position. So if the stock continues to shoot higher, you say, thank goodness I kept half, I'm getting a free ride.
Right.
And if it reverses and hits your break and stop, you say, thank goodness I sold half at a profit. It just eliminates that paralyzing regret that plagues most traders. It turns a high-stakes decision into a win-win psychological outcome, and that frees you up to concentrate on the next high-probability trade.
We're going to transition now to the final and maybe the most crucial section, the champion's mindset. Because none of these technical rules matter if the mental game isn't flawless. We start by tackling key 1, which challenges the idea that market timing is impossible. The sources argue pretty powerfully that timing is everything.
The belief that you can't time the market, it's typically a reflection of personal failure, not some kind of market mandate. Superperformance is entirely predicated on timing. It's not about being right 100% of the time. You might only be right 50% of the time.
It's about when you're right.
It's about preparing for those right time, right place moments where you can enter a VCP breakout, manage the risk tightly, and let the winner run. Timing is about efficiency. It's about capitalizing only when conditions are optimal, as outlined by that trend template.
And the math behind timing and compounding is just astonishing. We often chase that single mythical 100% return, but the data shows the power of consistent smaller returns.
This is a huge shift in focus for most people. The goal is consistent execution that delivers returns that compound rapidly, leveraging the time value of money. If you achieve 12 consecutive 10% returns, compounded, you will more than triple your money. That's a 214% return.
Wow.
Now, compare that to chasing 4 20% returns, which only yields 107%. It is significantly easier to find consistent, smaller gains that compound rapidly with higher turnover than it is to wait months or years for that single massive move that may never even happen. Consistent execution of high probability moves, no matter how small, is the path to rapid capital growth.
Key 2 is the defensive application of scaling, which reinforces what we discussed earlier. Trade small before you trade big.
This is a psychological protective measure. You only increase your overall exposure, trade larger size, when your timing and analysis are proving correct. And that means you've built up a cushion of realized profit. Losses, when they happen, are simply information.
That's all they are.
If you experience a string of losses, you must reduce your exposure immediately. This is the mechanism that ensures that when you're trading poorly, your losses are minimized and your confidence is protected. And the absolute avoidance of revenge trading, betting larger to try and make up a loss, that is critical to a champion's longevity.
The rest of the mindset discussion, which draws on performance coach Jarek Robbins, it centers on conquering that crippling emotion of fear. Fear of missing out, fear of loss, fear of being wrong. And the antidote is total detachment.
Detachment is the champion's emotional force field. Fear is the primary cause of self-sabotage. It leads to paralysis, chasing prices, or selling your winners way too soon. Detachment means you execute the strategy with total certainty, regardless of whether that specific trade wins or loses.
The outcome is irrelevant.
The trade's outcome is irrelevant. Adherence to the rule is everything. And to achieve this, the sources suggest you have to fuel up and pressurize daily.
What does that mean?
Think of a full pressurized soda can. It's extremely difficult to dent. You need to mentally rehearse scenarios every single day, even imagining and accepting the pain of worst-case losses, so that when they occur in real time, your nervous system doesn't trigger panic and lead to irrational behavior like selling at the bottom or moving a stop. You prepare for the loss so it doesn't become a surprise.
This preparation allows the champion to shift their focus entirely from the outcome to the process.
The money is a byproduct of effective execution. It's not the focus. You can't hit a home run by focusing on the scoreboard. You have to focus on the mechanics of your swing.
Right.
The focus has to be on being the best decision maker you can be. concentrating entirely on making every single decision a quality choice, adhering to the plan, the VCP, the trend template, the free roll. When you focus exclusively on the quality of the process, the money follows, naturally and consistently.
So how does a champion build that consistent process and learn constructively from the inevitable setbacks? It's through the positive feedback loop.
This has to be a daily ritual. Before you trade, you have to review and write down what went great the previous day. And this isn't just about your wins, it's about following the rules. For instance, celebrating a small, rule-based loss.
Celebrating a loss.
Absolutely. Then identify 2 or 3 clear lessons you learned from the previous day. And finally, ask yourself this simple, high-leverage question: how am I going to improve today? Writing this down forces conscious incremental progress, and it helps you spot and eliminate those repetitive errors that are rooted in fear or impatience. It reinforces the desired behavior.
The ultimate battle, it seems, is conquering the trader's ego, which is what compels people to hold on to losses because they just don't want to admit they were wrong. This requires a complete reconditioning of the neurological pain-pleasure cycle.
This is the neurological core of self-sabotage. The ego makes a small loss feel painful, right? So it prompts the trader to avoid that pain by holding the loss, hoping it will turn around.
Until the loss becomes so massive that the pain is overwhelming.
Exactly. To break this cycle, you must consciously and emotionally celebrate small, rule-based losses as huge victories. When your stop is hit, the instruction is to immediately engage in emotional stimulation. Jump up, do a happy dance, pump your fist. I'm serious.
You're changing the association.
You're changing the neurological association. You are training your brain through classical conditioning to associate following the rules, taking that small, predefined loss with pleasure and positive emotional reward, regardless of the immediate financial outcome. This replaces that old fear-anxiety reward cycle with positive reinforcement for discipline.
That is a remarkable technique. Forcing physical joy at the moment you take a loss to rewire your brain to prefer discipline over your ego.
It's the highest level of mastery. You are controlling your physiological response to stress. You are conditioning yourself to accept that the small loss is an expected cost of doing business, and executing the stop is the success, not the failure.
Finally, the difference between long-term superperformance and just fleeting success is captured in the choice between mastery versus dabbling.
Dabblers quit when the enthusiasm fades. They'll pursue a strategy only while it's easy and it's making them immediate progress. But every high-level performer in any field hits an inevitable plateau.
A wall.
A wall. A period where progress stalls, the system seems to stop working, and frustration just mounts. Dabblers quit at the plateau, they change systems, they chase the next magical formula. Masters. They view these plateaus as necessary opportunities to hone their technique, to deepen their understanding of their proven system, and to persist unconditionally. Longevity and true success are achieved by the commitment to stick with the plan until mastery is achieved, even when the market is testing your deepest confidence.
That concept of unconditional persistence, it really ties this entire playbook together. We've covered everything from the technical structure of the buy signal, the trend template plus the VCP and pivot, the importance of that brutal portfolio hygiene with the 2-for-1 rule, and the essential psychology of detachment and the free roll technique. For the learner, this isn't just knowledge. It really is the operational guide to repeatable success.
It is. And remember that knowledge alone is passive. To achieve champion status, you need the mental commitment to consistently execute the plan, especially during difficult times. That disciplined, repeatable application of sound rules is what truly differentiates the great performer from the mediocre one and ensures longevity in the market. The moment you fail to follow your system, you are trading on emotion, and that is where self-sabotage begins.
Thank you for watching us. Please like, share, subscribe, follow up in the next video.